Hey there, so you're thinking about taking your business international? That's awesome. But, your accounting system is going to need a serious upgrade. So today, we're going to build the blueprint for that. We'll break down exactly how to handle those global transactions from start to finish.
All right, let's just dive right in. Because look, once you start dealing with foreign currencies and customs duties and all these international taxes, it is a completely new ballgame. Your standard everyday accounting setup? Yeah, it's just not going to cut it.
So, here's the plan. First, we're going to build the essential foundation in your accounting system. Got to get that right. Then, we'll jump into some real-world examples, an import and an export, to see how this stuff actually works. After that, we'll figure out what the true cost of an imported asset is. Spoiler, it's more than you think. And finally, we'll tie it all together and see how all these moving parts really hit your company's bottom line.
Okay, first things first. Before you even think about making your first international transaction, you have to build the skeleton in your accounting system. Believe me, getting this right from the very beginning will save you from some massive headaches down the road.
It really just boils down to these three crucial steps. First, you've got to get your system ready to handle multiple currencies. Second, you need to set it up to correctly account for all those different taxes and duties. And third, you need to create some custom vouchers or workflows to keep everything nice and organized.
Okay, now this is a big one. This is where a lot of businesses trip up. You might think, hey, I'll just use one daily exchange rate for everything. Nope, that is a major mistake. Your system actually needs 3 different rates. You need a standard rate for your reports, a selling rate for when you're buying foreign currency to pay for imports, and a buying rate for when you're selling the foreign currency you get from exports. I promise you, mixing these up will seriously mess with your numbers.
And of course, taxes. Every country has its own crazy, complex tax rules. Let's take the Indian GST system as an example. You have to set this up just right. For imports, you pay a tax called IGST. But the good news is, you can claim that back later. For exports, though, if you have the right paperwork, like a letter of undertaking, it's a 0-rated supply. That means no tax. But you can see how getting this configuration wrong could lead to some really costly mistakes.
All right, so we've got our foundation in place. Let's see how this all plays out in the real world. We're going to walk through a case study, importing a $10,000 CNC machine all the way from the USA.
So step 1 is just recording the purchase invoice. Pretty straightforward. We debit the CNC machine asset account for $10,000. Bam, it's on our books. And at the same time, we credit our supplier, ABC Corp USA, which creates a liability. We owe the money. Now, at the exchange rate on that day, let's say 80 rupees to the dollar, that comes out to 8 lakh rupees. Simple enough, right?
All right, next up, customs. Before that machine even gets off the boat, you have to pay up. Now notice there are 2 different costs here. First, there's the basic customs duty. That's 80,000 rupees. That's a cost, it's gone, you can't get it back. But then there's the IGST, over 1.5 lakh rupees. And this part's important. You pay it now, but you get to claim it back later as a tax credit. Both payments, of course, come right out of your bank account.
So a few weeks go by and it's time to actually pay the vendor. But, oh no, the exchange rate has changed. It's moved from 80 to 82 rupees per dollar. It doesn't sound like much, but it means you now have to spend an extra 20,000 rupees just to buy the same $10,000. And that difference? That gets booked as a Forex loss. It's a real expense, and it hits your profit and loss statement directly.
Okay, so after all that, what's the machine actually worth on your books? I'll give you a hint, it's not the 8 lakh rupees from the invoice. We need to figure out its true landed cost. And that brings us to this really important idea called landed cost. And look, this isn't just some boring accounting term. It's the actual all-in, fully loaded cost of getting that asset from the seller's factory to your doorstep. It's the purchase price, plus shipping, insurance, and this is the key for our example, any of those non-refundable duties you had to pay.
And this is the magic step. Remember that 80,000 rupees in customs duty that we couldn't get back? Well, instead of just expensing it and having it disappear, we're going to add it to the value of the machine itself. So this journal entry literally moves the cost from being a duty expense to being part of the CNC machine asset. We're capitalizing the cost. We're rolling it right into the machine's value.
So, what does that mean? It means the final value of your CNC machine on the balance sheet isn't 8 lakhs. It's 8.8 lakhs. That is its true cost. And that's the number you're going to use to calculate depreciation for years to come. See how important that is?
Okay, so that was an import. Now let's flip the coin and look at an export. This time, we're selling £5,000 worth of goods to a customer in the UK, and you're about to see how that currency risk can bite you just as hard when you're selling as when you're buying.
So the process starts pretty much the same way. We send out an invoice, we record the sale, we debit our UK customer, XYZ Limited, creating what's called an accounts receivable, that's money they owe us, and we credit export sales to recognize the revenue. On the day we send the invoice, the exchange rate is 100 rupees to the pound, so we book a sale of 5 lakh rupees.
But you guessed it. By the time our customer actually pays us, the pound has weakened. The rate has dropped to 98. So when those 5,000 pounds land in our bank account, it only converts to 4,90,000 rupees. And just like that, we have to book another Forex loss, this time for 10,000 rupees.
Okay, so we've been deep in the weeds with all these individual entries. Let's zoom out for a second. What does all this actually mean for your big financial reports? Let's look at the big picture impact.
This table really pulls it all together. Let's walk through it. On the balance sheet, you can see the import made our fixed assets go up, while the export increased our cash in the bank. Simple. Now the profit and loss. This is where it gets interesting. Both the import and the export created a Forex loss expense. The export also, of course, added to our revenue. And finally, you have the tax returns, where each one has its own special treatment. You claim that tax credit on the import, and you report the export as zero.
So what's the bottom line here? It's really a tale of two reports. On your balance sheet, doing this right makes you look stronger because your assets are valued correctly at their true cost. But on your profit and loss statement, every single one of these international deals, import or export, opens you up to currency risk that can literally eat away at your profits.
You know, this quote really nails it. Getting all this right, it's not just about typing numbers into a computer. That's only half the battle. The other half is making sure those numbers paint a true financial picture of what's happening. That's how you make smart decisions.
And that brings us to one last really important question to leave you with. Your transactions for the year are recorded, everything seems done. But is it? Because the process isn't actually over. At the end of the financial year, you are required to revalue all of your foreign currency balances. And that can create a whole new world of gains or losses on paper. But you know what? That's a deep topic for another day.